Mortgage rates have jumped substantially over the past couple of weeks. The question now is, will the rise in mortgage rates be enough to derail the housing market as we move further into 2022? Hi, this is Andrew with the S2 real estate team of eXp Realty. And mortgage rates are something that have been on the mind of a lot of people. We ourselves here have been fielding a lot of calls. People concerned about mortgage rates, and rightly so. We've gotten very used to, very comfortable, if you like, in an ultra low mortgage rate environment. And now rates have risen and they're on the rise and they're forecast to continue rising. And that is making some people nervous. I can completely understand that. What we're finding right now is potential home buyers are having two reactions. One is they're jumping into the market. They're saying, okay, we've waited long enough. I want to lock something in before prices and mortgage rates go even higher. So they're jumping into the market. On the flip side of that, you've got the other set of buyers that are saying, whoa, 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 wait a minute, inflation's soaring. You've got the economy, we're not sure what's going on. You've got the virus still, you've got this, you've got that. Now you've got mortgage rates rising. So they just kind of pull back and pause. And whichever camp you or anyone you know might be in, that's okay. Again, it's all about making the best decision for you. So I wanted to do today is spend a few minutes on mortgage rates, kind of give you a little bit of a historical perspective. And I promise you, I'm not going to geek out and try and do some super detailed explanation of mortgage rates, but I do want to provide a little bit of perspective and kind of share what's going on now with what we think is going to happen or what's forecast to happen in the months ahead, but also give a little bit of historical perspective on where we've been and where we are likely heading back to this year. So I'll go ahead and share my screen with you. So here on this slide, what we're looking at currently is what mortgage rates have done since January of 2020 until now. So basically over the past 2 years. And as you can see, right before the pandemic hit in January of 2020, we were running just over 3.7%. And as the pandemic took hold, mortgage rates tumbled. They got into that 2.65%, which is those ultra low mortgage rates I was talking about. They jumped up, then they kind of came back down. And then starting off this year, they've really moved. They've moved from about 3% to currently about 3.56%. Now, I know you may have seen rates differently. These are the mortgage rates according to Freddie Mac. And I'm using the Freddie Mac rate calculator here. And the bottom line is no matter which service you use to actually look at what mortgage rates are, the bottom line is all of them are saying the same thing with regards to them going up, right? The difference in the rate itself is going to depend potentially on points, fees, different things like that, loan type. But this is just the average that we're looking at for the purposes of this video. So 3.56. So we're almost back to where rates were before the pandemic began. I want you to remember back then, we were still in an incredibly healthy real estate market. Everything was still moving quickly, right? So if we put this into a little bit of a different perspective, here's looking at mortgage rates going back another couple of years. So from January 2018 to today. And you can see if we take where these rates are currently and we go all the way back, you'll see that we're still running below what we were generally seeing between January of 2018 and January of 2020. So even though rates are moving and they're moving up, they're not anywhere near a place where they're even back to where they were before all the craziness began. And I think that's important to keep in mind because, again, a lot of times we all have very short memories, right? We don't necessarily remember things from 2 and 3 years ago as well as maybe we should. So we get used to something. As I said at the beginning, we get comfortable very quickly. Okay, so right now, I'm not saying that the trend here is not making housing Is it impacting affordability? Is what I'm trying to say. And the answer is yes, of course it is. The cost of money is getting more expensive and house prices have been going up. But I think the key here is to understand that less affordable is not the same thing as unaffordable. So are we less affordable than we were 18 months ago? Absolutely, we are. Are we less affordable than we were 3 years ago? Not necessarily. Not when you factor all of this in. The difference between it when you factor wage growth in is actually fairly negligible, but it is absolutely something that we want to keep an eye on. Here's what Sam Kater, the chief economist for Freddie Mac, had to say about this. He goes, as mortgage rates rise, we do expect some moderation in housing demand, causing home price growth to temper. Okay, we've talked about that quite a bit here. The rise in prices is a result of supply and demand. Very high demand against low supply. We still have low supply, even though new home builders built more homes last year than in any year since 2006 and are forecast to build even more this year. Okay, but what we're seeing here and what Sam is saying is that as these rates go up, you will see some of that demand start to pull back. That will help bring some balance back into the market, which is badly needed for everybody. Okay, so the large number of entry-level home buyers is facing a shortage of entry-level inventory homes for sale that is needed to keep the housing market competitive. Now, if you saw the video from a couple of weeks ago, that's something that we did touch on as well. What we've seen over the last, actually, it's been happening for much of the past decade, but especially over the past few years, is a lot of people that were first-time home buyers years ago, when rates fell to ultra low levels and prices skyrocketed, rather than sell their first home and move up into the next larger home, they kept their first home. They could. They were able to refinance it at ultra low rates, pull the down payment that they need for their next home out, make that purchase, turn that first home into a rental, and it cash flows. Now they're building wealth. It's a shift just in buyer demographics. Very, very smart, very educated, do a lot of research. They're understanding that there's a way to build long-term wealth here, and that's exactly what has happened, and that's helped to suck some of the inventory out of the market. As Sam finishes here, he goes, in 2022, we expect purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022. So new home purchase originations to increase, but refinances are expected to decrease. That's not unexpected in a rising rate environment. So again, rates have risen, but how do we compare to decades past? It's kind of interesting when you look at it. Throughout the 2010s, we averaged just a little bit more than 4%, 6.27 in the 2000s, 12.7% in the 1980s, 8.86 in the 70s. So when you go back over the last 50 years, the mortgage rates we're still experiencing today are still exceptionally good. And that's something that we all need to keep in mind. Right now, not all of the forecasts have been updated yet. The last forecast for mortgage rates this year, we're showing rates somewhere around 3.7 to 4% by the end of this year. Yes, they've jumped a lot in the last couple of weeks as the stock markets come down and there's been some uncertainty going on, especially as the new virus variant picked up. What does all of this mean? It will start to settle down, according to what most of the experts are saying. And I think as we start to move forward, we're going to start to get closer to that average of 4.09% we saw throughout much of the 2010s. So lastly, kind of in closing today with regards to mortgage rates, you're going to be hearing in the news a lot over the coming months about the Federal Reserve and the Fed meeting and the Fed raising rates. What I want to point out to you today is that when you hear that and the Fed raising rates, that is not going to directly impact your mortgage rate. Okay. When the Fed raises rates, that impacts the rates of car loans, credit card loans, personal loans, things on that nature, store financing, All of those things are tied directly to the Federal Reserve interest rate. So when you hear that the Fed raises rates half a point or a quarter point, more likely a quarter, that's what's going to be impacted. Mortgage rates themselves are more closely tied to the 10-year Treasury bond. So if you want to get an idea on where mortgage rates are going, keep an eye on the 10-year Treasury yield, the yield on the bond. Here's what I mean. So this is what the 10-year Treasury yield has been doing since December 1st. You can see December 1st, it was at 1.43. It dropped, and then it started to bounce along. And then right at about the beginning of the year, right around the week of January 2nd, it's been on a steady increase, right? We saw a minor blip back down, right? Less than a tenth of a point, and then it jumped up again to 1.87. Why do I point this out? Okay, it's important to watch this because it's the best way to track where mortgage rates are going. Here's why. If we go back over the last 30 years, the green line on this graph represents the 30-year fixed mortgage rate. The blue line represents the 10-year Treasury rate. As you can see, they follow each other. They're mapped. They're pretty close together. The average spread over the past 30 years has been about or actually over the past 50 years has been about 1.7 points. Okay, so that's the important thing to keep in mind here. So watch what's going on with the 10-year Treasury rate and what the forecast is in that rate if you want to get a good idea of where mortgage rates are heading. So hopefully that helps kind of explain a little bit where mortgage rates are. And again, they are making an impact, right? They are challenging affordability, right? We do have wage growth to offset it, but we've also got that thing called inflation spiking its head right now. And I went into that in quite a lot of detail last week. So if you go and find last week's video, you can kind of see what I had to say about that and the impact that it might have. So again, if you have a particular situation you'd like to talk through in more detail, please reach out. We are always happy to talk to you. 888-447-9650, or feel free to shoot us an email at contact@s2realestateteam.com.